This house in Centralia, Washington is listed at $499,000, and we're going to walk through a real mortgage quote to talk about whether you would be able to buy this house if you make $120,000 per year. So we'll walk through two different scenarios, one where you are putting 5% down to buy the house and one where you're putting 20% down to buy the house. We'll walk through a real quote in each scenario and look at what your monthly payment would be like in each scenario, how much cash you would need to bring all into the deal, and then how much income it would take to qualify for the loan in each scenario. So this is a real mortgage quote that I'm pulling. My name is Landon Buto. I work with Cleveland Street Mortgage based in Bothell, Washington, and we are a local mortgage broker. So this is a real quote that we'll be looking at. It doesn't mean it's the exact numbers you're going to see when you actually go to get the house, or that it's an advertisement for the exact interest rate that you might get, but it will give you a reliable idea of what to expect, a little bit more than what you might see on an online calculator like Zillow or something like that. So hopefully it will give you more reliable numbers as well as some understanding of why the numbers are what they are and how they might differ if they do differ. So let's go ahead and look at this quote. Here are the two quotes, and on the right is the 5% down scenario. On the left is the 20% down scenario. And for both of these, in just a second, we're going to walk through the 5%. I'll show you the monthly payment. We'll walk through each of these numbers. But for both of these, I am assuming you have a credit score of 740. And if you're relatively close to that, if you're in the 700s somewhere, then your pricing, your interest rate, all that is not going to be drastically different. It will be impacted a little bit if you make it up to 760. It'll be slightly better, 780. Usually it's in 20-point increments that it improves or worsens. So it will be incrementally better if you can get up into those higher ones, incrementally worse if you're a little bit lower, but not drastically different. If you do get significantly below this, down to the 600s, then you will start to notice a pretty significant difference probably in your interest rate and your pricing overall, things like mortgage insurance. So just so you know, 740 is what I'm assuming. So let's get into the numbers. 5% down, your monthly payment is $37.61. Now there are four different components that go into that monthly payment. The first is homeowners insurance here of $150 per month. That should give you a pretty good estimate of what to expect. It won't be that will vary a little bit. It will depend on who your insurance provider is and what your coverage is, but that is a pretty common number for this price point for our area that we see. Taxes of $219 per month. I did draw that from the county website, pull the actual number for 2024 on this property. So that is the actual number that you can expect of $219 per month. Mortgage insurance of $111 per month. Now again, this is an estimate, but it's drawn from an actual loan product where this is what pricing is today. So this is an actual number, but it will vary based on the day and several factors. Mortgage insurance, if you're unfamiliar, is something you have to pay if you put less than 20% down to protect the lender against the possibility of you defaulting on the loan. So that's nearly universal. And if you do not, the only real exceptions to monthly mortgage insurance is if you pay a one-time premium. That the pricing on that, sometimes it pays off to just pay that up front if certain programs let you pay that up front. Not everyone will, but sometimes if you look at it, man, I could break even pretty quickly here if I just pay this up front. But it depends on the market. You can look into when that makes sense. But typically, lenders won't price it such that it makes sense to do that. Typically, just paying whatever it is up front. This will vary depending on what your loan amount is. It will vary depending on your credit score. It will vary depending on your down payment percentage. So if you got up to 10% down or especially 15% down, that would knock your mortgage insurance down significantly. This is actually pretty reasonable for only 5% down. This number could be closer to $200 to $300. So we're looking at $111 per month on mortgage insurance. And then the last component is principal and interest of $3,281. That's a function of your loan amount, which is $475,000. It's just your purchase price minus your down payment. So loan amount of $475,000. And your interest rate, which is 7.375%. Now I'm making this video on April 23rd, and it's a good idea of where we're at right now. Again, this is not an advertisement for the interest rate you could get, but it is a pretty good idea of where we're at. This is a live interest rate, but it's dependent on many factors of your overall financial and loan profile. So we're looking at 7.375 roughly right now for this kind of situation. 5% down, 740 credit, first time home buyer. You could, it'll depend on when exactly you come to get the loan, but we're around here right now. This monthly payment is just showing without your taxes and your insurance what's your monthly payment. It's just kind of your monthly payment from the lender's perspective, from the mortgage perspective, not including those two components. Points or credit. Points are a fee you can pay up front in order to get a lower interest rate. Credit is the reverse of that, where you take cash up front towards your closing costs from the lender in exchange for taking a higher interest rate. So most of the time you have the choice to do either of those. For context, so why is this number 294? For context, this number would have to be several $1,000s to have any significant impact on the interest rate, to bump it, to 7.5 or to down to 7.25. It would have to be several $1,000 one direction or the other in order to have any significant impact, because the lender, in order to get you down to 7.25% on a loan amount of $475,000, for that to be worth it to them, or vice versa, for it to be worth it to you to take that much of a higher interest rate, then that number would have to be pretty significant. The reason it's not zero is just because lenders don't price their they don't really show a zero points interest rate. They show their interest rates in 8th point increments, and then they tell you how much it costs to get that, or how much credit they would give you to take that. And so typically you're going to see at the very least a couple $100 of either points or credit. So this is pretty much as close to zero as it gets, though, in terms of points. 30-day lock period. That could be when you get your interest rate, you have to lock your loan for a certain period, and you have to lock your interest rate, and it's only locked for a certain amount of days. That could be 30, could be 60, 45, 90. Typically, 30 is pretty typical unless you have a good reason to take one of those other lock periods. No prepayment penalty. Lender fees, $1,195. Pretty much all lenders are going to charge you some form. Just make sure that doesn't get super high, but pretty much all lenders are going to charge you some form of lender fees just to cover their. It's how they pay certain fees and certain parties involved in their side of things. So that's very typical. Just keep an eye out that doesn't get towards $3,000, $4,000, $5,000 or above that. Other closing costs of $9,734. That's actually on the lower side for this loan amount, for this purchase price. I generally expect that to be $10,000 to $12,000. This is based on a few assumptions, but it's not unreasonable to expect below 10 for this purchase price, this loan amount. Other closing costs include things like paying all the people involved in helping you get the loan and get the house. Fees and services you have to pay to make that happen, and then also another component called prepaids. So those are just costs you have to pay that you will be paying on an ongoing basis as part of your monthly payment, as part of your mortgage, but you have to put some of them into escrow ahead of time. So that's other closing costs, $9,734. If you got a higher loan amount, something in the 600s or 700s, or a purchase price closer to the millions, this number could be as high as $12,000 to $15,000. It can vary a lot, but just for a basic loan in the average loan amount, average purchase price in our area, this is a pretty reasonable expectation. And then estimated cash to close. This is your down payment of 5% plus your closing costs is $36,000 all in. So that's all the cash you're going to have to bring to the deal to get this monthly payment. Now quickly we'll walk through the 20% down scenario and see how it's different. So right away you can see it's about $700 less per month, $3,132. We no longer have mortgage insurance because we hit 20% down. We don't have to pay mortgage insurance. We still have, these are the same, homeowners insurance and taxes are the same because they are dependent on the house. They're not dependent on the loan. And then principal and interest is now $2,763, which is a function of our loan amount of $400,000 and our interest rate of 7.375%. In this case, our interest rate did not change even though we got from 5% down to 20% down because of the particular loan program that we're in and because of the market right now. Sometimes that jump might move your interest rate down. In this case, it did not. Monthly payment, $2,762. That's just the principal and interest, no homeowners insurance, no taxes. But you will be paying these as part of your mortgage, part of your monthly payment. There are exceptions to that, but they're very rare. You can look into that if you want. Points or credit. This time 248 in points in order to get this rate. Again, pretty much as close to zero as it gets. A lock period of 30 days. Again, no prepayment penalty, same lender fees. And then other closing costs, these are now slightly lower because our loan amount is slightly lower, $9,597 in closing costs. So closing costs plus our down payment of 20% means all the cash you're going to have to bring all in is $111,040. Your down payment of 20% is going to be $100,000 basically exactly. The house is listed at $499,999, but I'm just using $500,000 purchase price for this quote. So cash all in that you're going to have to bring is $111,040. Now, what I'm going to address specifically is not should you. I'm not going to talk about should you do this. I'm going to talk about could you. If you came to the lender and you were making $120,000 a year, would they approve you for this loan? I'm not talking about budgeting. I'm not talking about whether you should take on this much of a monthly payment if you make $120,000. That's not what I'm addressing. I am addressing whether the lender would approve you for this loan. So the way lenders figure out whether you can qualify for a conventional loan is they look at your debt to income ratio. And your debt to income ratio is your total monthly debts divided by your gross monthly income. And your total monthly debts is this new housing payment you are trying to take on, plus any other monthly debts that you have. Credit card debt, student loan debt, car debt, any other monthly debts added with this new housing payment that would result from this scenario. And then they divide it by your gross monthly income, which is your income before taxes. And they take that number, and that number needs to be less than 50% in order to qualify for the loan. If it is less than 50% for conventional loans specifically, then the lender will approve you for the loan for the most part. Now, an important note on this number is that it has to be, this number needs to be income that the lender sees as usable, that the lender deems as usable, that qualifies in the lender's eyes. What I mean by that is if you have a salary, then the lender can look at that and say, for the, almost all the time your salary is going to be very usable, your entire salary. They still want to see certain qualifications within your salary, but if you have a guaranteed salary, then your entire salary is going to be pretty much usable. On the other hand, if you are in sales and most of your income is in commission, and that varies from one year to the next, and you've only been in that job half a year, or you're making twice this year what you were last year, then that number is more difficult to calculate for the lender. So if you're in any other scenario than salary, if you work variable hours, you work more hours this week than last week, and it's not the same every week, or if you're self-employed, or if you're in commission, any other pay structure, that income needs to meet certain qualifications in order to be usable. So the lenders have various ways that they figure out about what number to use down here. if you are in any of those pay structures. Whatever number they end up deciding on, that number, your total monthly debts divided by that number needs to be less than 50%. So if that's the case, then let's assume, usable income, and let's assume you have no other debts. If you have no other debts, then we just divide this number by a gross monthly income and see if it's less than 50%. If you have other debts, you just add that number. If you have $200 a month of credit card debt, you just add that number to this top number, and then you divide by your gross monthly income and see if it's less than 50%. But I'm not going to use other debts. I'm going to assume you have no other debts. Then your usable income, your gross monthly income, would need to be twice whatever these numbers are. So in the 20% down scenario, you would have to be making $6,264 per month. And in the 5% down scenario, you would have to be making $7,522 per month. Let's see what those are per year. Okay, so per year, 6264 is $75,000 per year. And then annually, the 7,522 is $90,000 per year. So yes, you'd have to be making more than this. Assuming you're making anything more than this, $1 more than this, then this ratio will be less than 50% in each of these scenarios. So yes, if you're making $120,000 per year, technically the lender would approve you for the loan. Obviously, there's the budgeting side. You have to figure that out on your own, what you're comfortable with. But as far as qualifying, it's important to be able to figure out that number. So if you want to get a quote on a house that you are looking at personally, or if you just want to have a loan officer look at your income and see how much house you could qualify for, we'd love to help with that. We do loans in Washington and Idaho. Again, my name is Landon. I work with Cleveland Street Mortgage based in Bothell, Washington. We do loans in Washington and Idaho, and we love working with new clients. So please do feel free to reach out. All of our contact information is in the description below, and you can reach us there.